So, hello, and a massive hello to everybody. How we all doing? Rocking and rolling in a free world. Here we go, here we go, here we go. No trade calls, no recommendations, or response for their own stuff. We're here for educational purpose only. 50 pips in the house, 10th of April, 2020. So, hope everybody's having a great quarantine wherever you are, whatever you be doing. Let's do this, let's do this, let's do this. So, there's no real agenda for today. Basically, I know markets have been a little bit tricky. Times are a little bit tough. A lot of people are going to be at home. So hopefully, I'm just dedicating an hour or so of my time, whatever, we'll go as long as we need to. We can do it, call it an Ask Me Anything or weekly review or whatever. I don't care. Nothing's off the table. I'm just going to take questions as they come and try and get through as many as I can in no specific order. Hello. Good to see a lot of usual suspects in here, and let's get cracking and let's get going. So, looks like sounds okay for everybody. Hello. Good stuff. Great to see everybody in here. Yeah, I mean, sound issue is fine. As far as all the systems are saying, the webinar will be recorded. So in case anybody has any issues, don't worry. I'll post the recording. So it'll be up on the blog. It'll be up on YouTube. So. Hey Sham, how's it going? First question. Thanks for doing this webinar. Sure, thank you. Hope you're doing well. Hope everybody's good. So you said longs are finished, but tactical trades will be on. What do you mean? So basically, I suspect you're referring to the comments I made on Twitter. Hey Knud, long time no see. Good to see a lot of old timers in here. So basically, okay. So let's just go through what we've been talking about right now. Sometimes all my comments on Twitter basically are based on, I assume that you're following the YouTube videos I'm putting out and the Twitter commentary and the charts we talk about on the blog, where I try and share as much as I can, what we're doing in the premium side of the services, right? So what we were discussing was basically, well, first of all, we were looking for some kind of a top, right? Even before the whole coronavirus, right? So basically, our base case coming into the year, right? Our base case coming into the year was that we had this kind of break up above the 18,000. I can do it on any chart, right? I'll do it on the NASDAQ just for the hell of it. And our base case was basically that this break higher, we'd seen this kind of low volume chop and then ramp, overnight ramps, et cetera, et cetera. Our base case was that this was one of those kind of squeezes that the market that's going to come undone in a fraction of the time it takes to ramp them up, right? We're just looking for some kind of catalyst, some kind of opportunity to try and get short, okay? Once the coronavirus things became clear, we were even more aggressively looking for the shorts, right? And you see that on this ramp, you had a couple of clean occasions to try and get short, some nicer than the others, right? So first of all, you had the nicest one was probably this negative reversal here at all-time highs, right? Where the market broke down below the 10-day moving average. And it tried to get a little bit of traction, but it couldn't, and it went up for this last squeeze, and then you've got this beautiful little reversal at highs, and then we all know what happened, okay? Now, here, what we were looking for we were looking for, first of all, the market to undo this whole squeeze back into the 8,000 for starters. But what we were looking for in terms of a bigger picture is we were looking for a bigger retracement on the higher time frames on the weekly. By the way, all these shorts were also, all the traction was confirmed by closes lower even on the 10-month, et cetera, et cetera. So you see how we came all the way back down into on NASDAQ, and this is the clearest one I was putting up on the blog and stuff, is we pinned right at that 100, oh sorry, the 200 week moving average, and we reversed hard, right? What was interesting in this reversal, actually, if you look a little bit closer, and again, markets are usually, if you can step back and listen to what the market is telling you and watch price, it's not that complicated to see what's going on, right? So you see we had, does it make sense that the initial puke that started here, right, in terms of 1, 2, 3, 4, 5, this week here, do you see this one? Give me a hands up if you, this was a big, let me make it even bigger here. This was that big buys that came out of the 7,000, right? And we rallied all the way back up and we closed the week with this huge wick, right? So here, of course, remember, stuff always looks ugliest on the lows, but then the picture was very, very different, right? So what happened there? Then we had another puke that came down back below the 7,000 once again, and the market hesitated. Then a third week where we went back above and we got went back below the 7,000 and back above, right? And this was a very nice long signal, right? Because all of a sudden this was the panic low. We clear it once, market still closes the week heavy. We clear it once again, and where do we bounce? We bounce right at that 200 week moving average. And at that point, we closed back above the 7,000. We actually closed back above the 7,500. This is when I was talking about the 8,000 was attracting, right? So this was a beautiful sign of, you know, at least an initial bottom. And what do you look in these cases also with, you know, Fed coming in, fiscal across the world, right? All this monetary fiscal policy. We've been talking about them throwing everything they can at it. Well, at that point, you're betting on this to get some traction and rally all the way back to the 50 back of the move, right? So move off all-time highs, move from A to B, right? What does market do? It comes right back into the 50 back. Okay. Now, I believe I tweeted that question that now it gets tricky when we made it back to the 8,000 mark, right? So what happens is that the first move down, so the quick pips to the downside, those came very quickly. This squeeze back to the upside, back into more neutral territory, into the 50 back, is done. Now it gets a lot trickier, right? Now it gets a lot trickier. Why? Because, well, technically, if we're going to go in a prolonged bear market, if we're going to go and retest those lows as everybody seems to be so sure we're going to do, well, this is a great place for it to fail, right? What you would want to see it is you would want it to come up, hold this 61.8, 50 zone, right? And then fail from here, go back down, retest those lows. God knows what it can do in between, but then come down in extension into the 123 extension of the move from A to B, right? And that would complete this. That would complete this move here. And however, I think here becomes a lot trickier because of the context, right? Because of what the Fed is doing, what all the central banks around the world are doing, what all the fiscal that's going to be thrown at it, so fiscal and monetary that's going to be thrown at it. The picture is just not as clear. So I think that in terms of a normal move, I wouldn't normally say that, but because here we've had the kitchen sink thrown at it from the central banks, and because of the unprecedented situation we're in, now I think it gets much trickier. So for me, this is the place where, as much as we were screaming, you know, get short, get short, get short, or get long, get long, get long, now it's a lot more tactical. Does that answer your question? So here again, you can make there are a lot of, you know, and it's a very similar chart on the ES2, but again, now the fight is on, because you have a situation where the situation is you can quite eloquently, I think, make a really good case for the bottom to be in, and an equally good case for the fact that there's no way the bottom is in. We have to go much lower. Okay. And always you need two sides to make a market, but here it's not so clear cut, because technically I can easily make the argument that this is a beautiful little retracement, that nothing is solved, that the reasons that led to the sell-off are all still there. The imbalances in the markets are still there. The economic situation has actually gotten worse. You can't just turn the economy on and off like a tap. The world is not going to go back to the way it was before, in terms of people aren't just going to go back to restaurants. People aren't just going to go back to hotels. People aren't just going to get back on a plane, et cetera, et cetera, et cetera. So a lot has to get worse. We'll have to see earnings coming up. Banks start reporting earnings next week. And the longer this continues, the uglier the economic situation is going to be, the higher the chance of bankruptcies, small companies, high yield, whatever. So we still haven't seen the end of this. So it's only natural, it's only normal that the market will, after this relief rally, and even if we get more rally because of the jawboning, the market will have to come back to reality and retest those lows. And because the situation will likely not be clear for at least 6, 12, 18 months, we're going lower before we go higher. Okay. And I think nobody can really argue with that assessment. Okay. It makes sense. It's not crazy. Okay. On the other side, I think you can equally make a case for saying, yes, 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 all that is true, but the amount of stuff that they've thrown at it from a fiscal and monetary side is being unprecedented, right? The numbers are just they don't make sense anymore. Trillions, billions, gazillions, it doesn't matter. They'll do whatever it takes. So they'll just keep on throwing whatever they can at it. The numbers will be bigger if they have to. They'll go in, they'll get Congress to agree, they'll come in and they'll buy stocks. All the central banks are going to buy ETFs, stock ETFs a la Japan. They're going to do a debt jubilee, whatever it takes, and they're going to stop this. So even though we may retest those lows, there's no way they're going to let this go lower. If not, everything implodes, not to mention not only the economy, small businesses, high yield, the pension funds, everything. So they just can't let that happen. It's too important, right? And I think there's a case for that too. That's why I said when we came down in the webinars we've been talking, you have to consider the fact that maybe the low is in, right? Maybe the low is in. So I think both cases are very plausible or make sense. I think the reality is that anybody who is convinced about how the market is going to react is deluding themselves, right? Nobody knows. The situation is far too uncertain. We'll have to wait and see. As always, I recommend, instead of having an opinion or having a bias, is to just to focus on what price is doing at the specific levels. So gun to my head, I would expect that on any silly rip is still going to be a nice selling opportunity, right? Tactical selling opportunity. Maybe it's for an overnight trade. Maybe it's for a couple of days or whatever. And any kind of really ugly panic day is probably going to be a nice tactical long opportunity, because you're bound to get the Fed announcing more stuff being announced, more stimulus, God knows what. So I think here the kind of bigger double-digit moves were far easier to read than the next move is going to be to read here. Only because of the unprecedented stimulus that's being chucked at it, and the fact that they really are going to do whatever it takes, and what they're doing already is just absolutely bonkers, right? So I'm not really a fan of debating if it's right, if it's wrong. I'm here to try and trade the levels, right? The only thing I would say is that I firmly believe that the situation is going to get worse before it gets better in terms of economy and everything. It's going to be a bloodbath, and a lot of people don't comprehend how bad it's going to be. But equally, even if the Fed and everybody was a little bit late to react in 2008, 2009, here they've been very, very early. And do not underestimate the power of the central banks. Do not underestimate fighting against somebody that has unlimited buying power. And just here you've got a big choice, right? Here you can be like the guys that got stuck in 2008, 2009, saying that this was all a Fed bubble and that the world was going to end. And you can spend 10 years fighting against it, right? And being mad and being a perma bear on Twitter. Or you can understand that what they announced here in terms of stimulus, whatever, on a monthly basis, they're doing here on a daily basis. So I'm not a fan of fighting the Fed, and I'm not a fan I don't want to spend the next 10 years being a perma bear. Does that mean that I'm not going to trade it to the downside? No. Does it mean I'm only going to trade long? Absolutely not. But I understand the situation, the unprecedented amount of stimulus they're throwing at it. So last thing I'm going to do is start shorting this into the hole and be a Fed hater and blow up my account, right? Remember, we're here to make money, to manage your risk and make money. So, who cares about the bias? Who cares about what's happening? If you that's good to have a chat with people, but if you're in front of the screens trading, your only concern is what price is doing and trying to take advantage of that, right? And again, the other thing is, a lot of people are going to be very going to want to do a lot of historical comparisons, look for analogs and stuff, but all those analogs and historical comparisons are much easier after the fact, because if you throw enough spaghetti at the wall, sooner or later one is going to stick, and in hindsight everything looks so pure. But shorter term, if you don't get your risk management right, the margin clerk's going to be knocking at your door, and it's far it's not as clear cut, right? Yeah, again, I mean, the problem is it's the same thing as all those people. We discussed this on the ES, right? There's a beautiful longs here. Is everybody getting going on about the ugly jobs number and all the ugly numbers and keep on wanting to get short? As I said the other week, I'm sorry, but anybody that spends their day getting surprised by the ugly job numbers or the ugly PMIs or whatever, either you're seeking attention on Twitter or you're a journalist and you need some clickbait. Is it a surprise to anybody who's paying attention that the jobs number are going to be horrible? If you're living on a different planet, maybe, right? But if you're living on planet Earth, the job numbers are going to be beyond stupid, right? Especially when the first ones came out of the US, we'd already seen the numbers in Canada, right? So you had no excuse to be surprised. So, and again, the PMIs come out, they're crappy. Well, of course, earnings are going to come out. Is it going to be a surprise to anybody that all the companies are going to say, we have no idea what's going on, we're not going to give you any guidance, we're going to cut our dividend, we're going to fire people? That's the only thing they can do, right? So that's what you have to keep in mind. It's the same thing once we came into this 2400 on the ES, right? Markets priced in pretty much, 2-3 months of lockdown everywhere. Markets priced in 0 occupancy rate for hotels, 0 restaurants, 0 plane flights, etc. That's all priced in. So now the only thing that's going to shock the market is something that is not priced, something that is truly horrible. So in the context of this, any news that comes in that's in line with what would be normally expected is bullish. Anything that's slightly better is bullish. As sad as it may seem, if people are expecting to see, say, 1,000 people die every day in New York or in Italy, and it's 999, that's bullish, right? So the market is always forward thinking. So all that's priced in. Now, of course, it's not for some people because some people just woke up, but to anybody paying attention, it's the same thing. This has been evident for ages. So now after the flush, now it became pretty much evident for everybody, or forced to be evident for everybody. So now it's what you have to look at in terms of downside catalyst. You have to see something really bad. So that probably means like if numbers in Italy pick up again, if numbers in New York pick up again, if what we see in New York starts to happen in Washington, Chicago, LA, right? Something new. But right now, where we are, horrible data, horrible earnings, economy on lockdown, economy on standstill, all this stuff is being priced in. So you're going to need to see something different. It's no news, right? It's no news that earnings are going to be crap. People are going to get laid off. All this is priced in. But again, it's not going to help you to have a bias, because chances are your bias is already being priced in by somebody else and they've already moved on and you're still stuck on that original bias, Salam, right? Look at the levels. Yeah, it's the same thing here. I don't care how bearish you are. Look at ES. The 2400 was a key level. We discussed that a while. So you keep on getting horrible data, jobs, 1 million, 2 million, 6 million. And what's price telling you? Price is telling you, I don't care, right? But we're keeps on getting bought. Higher lows, price is going up, right? So there's nothing, since this basing of the 2400, there's absolutely been nothing on the chart which is bearish, right? So whether you're a bull or a bear, even if you're a bear here, you're looking for this to get higher, so you could lay him back out at a higher level, right? Remember, the trade is never a lot. What of the more junior people make this mistake, right? They say, "Oh, it's dead, right? This is dying, and this has to come." Let's say their assumption is it has to come back down, and we're printing 1600, whatever it is. Price doesn't move in a straight line. There'll be a lot of moves. It just happened that you've had, the VIX going through 80. This is a once in 10-year event. You can't plan on that happening every day. So if you're playing with the gods, not against the gods, if you're playing inside the bell curve, not outside the bell curve, you're expecting things to normalize. You're expecting the VIX to come back down. You expect to see some more two-sided trading. You're expecting to see slightly lower daily ranges as the VIX is coming back down. You can't bet for another 20-30% move in the same velocity in the same direction, right? To keep on going. Here, look at what we've priced back out, right? Essentially, this is the election range, and our base case was always that this was a BS Trump rally and it was all going to get undone sooner or later. And right now, it's undone. So what more do you want? You see what I mean? It's like the whole Trump presidency, bam, undone. So this is a huge reset. So the damage is already being done. So again, 4 years have been taken out of the market in a couple of weeks. So the reset. So now, we have to see what's next. But it's early. But so far, the action has been extremely technical, right? Here you had hold here of this previous resistance acting as support in line with the 100-month DMA, 100 MMA. So again, a lot of markets still being fairly normal. It's just you can't. A lot of people. What's that Stan Druckenmiller quote? The mistake, or I think it's maybe Tudor Jones. A lot of people have the problem that they have a thesis or a bias or a trade idea on a monthly time frame or on a weekly time frame, and they expect to manage that or trade that on a 5-minute chart. You have to trade the time frame of your view, right? You don't want to mix those, right? We'll have to see what happens with vaccines, etc. But even if you find a vaccine, things aren't going to just go back to normal in a millisecond. It's going to take time. But the market's always forward-looking, right? So again, what's the view on gold? What's going on gold? Well, gold is an interesting one. Let's see. Again, a lot of people have very, very strong feelings on gold. Um, for me, it's just another chart. And what's gold is playing out here again. The gold bugs are going to love this, and the gold haters are going to want to leave the webinar. But here, what gold is trying to play out from a bigger view, right? Bigger picture view is you've got this huge move A to B, right? And we've come right back and we held the 50 back, and this whole, so what this is indicating to me is that at the very least, especially because of the confluence with the context we're in, right? Not only the risk off context initially, but here in the context that central banks are going to be printing like there's no tomorrow. We're going to have like Zimbabwe gazillion dollar bills, right? This is all very inflationary, if not, so if not hyperinflationary. So here, everything points to a beautiful environment for gold. So whether you're looking at the chart or whether you're looking at the fundamentals, everything is very bullish gold, right? Now that doesn't mean it can't go up or down 5-10% on any given day, but bigger picture, the what I would be looking at here is at the very least is to see gold make it all the way back up and test those highs, right? So towards that 1900, 2000 mark. But the move, if the move completes, I would be looking at 2300 on gold. Now, if you're looking about extensions, I don't think something I would be looking at for today. Again, I would not be surprised to see, 2800s. That's really not my base case now because I don't like to look that far ahead. But this is what it's pointing to, right? So, we were long gold already as usual every year, pretty much into the last Fed meeting of the year, one of those classical seasonal plays. And then this got a lot more traction very aggressively. But, if you've just somebody hit you over the head and you just woke up now, clearly to me, this is not the place to come in and try and buy gold, right? Even though the outlook is bullish. So here I'd be looking for some kind of a retracement, but you have to keep in mind that here you're coming into huge structural resistance. So, it's really hard. I think the best case scenario here would be if you're looking to get back in gold, what you'd be looking at is you'd want to see some kind of the market go completely stupid up. So ES towards the 3000 mark, something like that. And maybe a little bit of pressure off and to see gold come back down. What would probably be a gift to from the gods would probably be a move back down towards that 1500. That's a huge move, right? Again, keep in mind, there's a lot of hanky-panky going on in the gold market at the moment. So you have no idea how this is going to clear. But I would say that any kind of silly move back into the 1550 or 1500 would be a very interesting place to start to possibly look for longs again. What's interesting with that zone is that if you look at it here already on the daily, right, it's coming back, you've got all this conference of the moving averages on the daily. If you look at the most recent ramp from lows to highs, the 50 back zone is coming in there. And on top of that, if you look at it on the other, on the weekly, you've got that you're going to have the 50 week coming in. If you're looking at it on the monthly, you're going to have the 10-month moving average there. So those are all interesting areas, right? I think it's a tricky one here. Intraday, I'm really not a huge fan of trying to trade gold or crude here intraday at the moment. But that's what I would be looking at in terms of gold. Yeah, it's going to take up about 40 minutes of the webinar. Just Google it, Arno. Just Google, difference in spot and physical gold price. There are a lot of things. A lot of people are talking about a lot of things, but, just give you the easy one, right, is if people have to move around physical and the airlines are not flying, Is that going to be, yeah, you see what I mean, Arno? So, people ask for delivery, or people have to move around physical, and the airlines are not going. Usually, a lot of the physical is moved even on commercial airlines, right? And now those aren't flying anymore. It just, everything gets, and then there are a lot of fun and games being played, but it's a long discussion. I don't think it's really that useful for trading, right? Just look at your charts, let the charts guide you. What's going on with silver? So silver is a little bit more tricky. Keep in mind that, again, there are a lot of discussions on silver and how much of it's a precious metal officially, but it's really a lot more of an industrial metal than a precious metal, right? So what you'll see is here, it's kind of getting caught in the cross currents. And so I'm not a huge fan of doing anything specifically here on silver, but if I had to as a tactical trade, I prefer to be, if I didn't want to have a naked position on it, I'd prefer to tactically look to get long silver against gold shorts, right? And but again, I'm just not. It's just not something I'm too focused on right now. If you look at it technically, right? Yeah, I mean, it's a tiny market, right? That's the thing. It's a tiny market. There's a lot of wheeling and dealing. But I mean, technically here, it's what it's doing is interesting, right? Look at it in terms of the monthly, right? This is an interesting chart. So remember we had, all these lows that have been holding, multi-years, 2013, 2014. And we said it's interesting area, right? But you have to be careful because silver likes to fake people out. Gold and silver, you like to see fake outs and funky kind of action. And you've got to be very suspicious here. Usually these things end with max pain. And you see what's really interesting here is, bam, everybody got smacked, right? The retail pikers tried to short this because it's going to zero. You got to love when you see people on the net talking about commodities going to zero. And what happened, we closed back above that zone, right? So then looking at it here, you had this descending trend line. It's trying to get back above that descending trend line, right? So all this points to possibility of a massive fake out here, right? That then if we turn, when this starts to move, it's kind of like gold on steroids, right? And so again, this is clearly potentially setting up a massive fake out, closes back above this zone, and then it'll be looking to try and take out those recent highs and go back into those levels we were playing for. If you remember, I think you were in the room back then when we got long for these initial two moves, and it just stalled here. But those are very nice longs, right? So I think it may be setting up that again. The problem here, especially if you're trading futures, right? These are big boy contracts. These are silly moves. So it's not something I'd really want to be too interested in. I'd prefer, if I had to, again, to put on some kind of a pairs trade. So short gold, long silver here, but I'm not doing anything. I don't have a position on here. Okay. What's going on crude? What's going on crude? Well, a lot of fun and games and a lot of junior traders with trading futures when they shouldn't be trading futures on small accounts are likely getting carried out in a wheelbarrow, right? It's not pretty. But what's happening is not a lot, right? It's stuck at those lows, right? There's just not a lot is happening, right? So yeah, I mean, so you see here on the weekly level, we came back into this area, and what we said is not too interested in doing anything, but it's hard to see why anybody would want to press crude short in the 20s, even though it could easily go lower, because, chances are with all the jawboning, and there were nice few tactical longs when pretty much Trump told you he was going to get involved and start jawboning it, right? But here, what's happening from a bigger picture? Well, bigger picture is, crude, world's awash with crude. They're pumping like there's no tomorrow, and it's sitting around everywhere. And no surprise, nobody needs it because nobody's moving, right? Airlines aren't moving, cars aren't moving, people aren't building anything. You see what I mean? So there's a real problem here, right? Now, bar what's happening in the real world, what happens in the charts can be a little bit different. So here, it's the same thing. It's the same trade as equities to a certain extent, where you could make an argument here to say that basically the world is shut. There's too much crude going around. They don't know what to do with it. There's no way this is going to pick up. There's no fundamental reason for this to go up. This has to go down. We're talking about this going into the 15s or even the 10, right? And if you look at that even from a bigger picture view, the current move here, right? Highs to lows, A to B, sold at the 50 back is giving us a 123 extension into the 5. Okay, so that would be the move. Okay. So that would be, and that makes sense. Hard to argue with that. However, the question is, now that Trump's involved, are they going to let shale go bust? What happens to all those states which are key voting states for Trump? Is he going to let them go bust? I don't think so, right? So here, I think the easy part of the move is also done, because if anything, you'd expect to see some kind of relief, upside traction, but likely, unless something really solved, any rally is a sale, right? And in the similar fashion, like the equities, any aggressive puke, because they'll throw everything they can at it, is probably a tactical buy. So I'd be a seller of sharp rallies and a buyer of silly pukes. And again, you see even here the way this is behaved, you've got these big moves down. So 77% down, 77% down, and here again, pretty much 77% down. So you see, it's an interesting thing that's recurring. A, B, and then pops, highs to lows and pops. It's again another 77% off these highs into these lows, 77%. So again, I just don't think that as much as Putin and KSA or MBS want to play we don't care, there's a point at which they care. So I think even if they're going to keep pressure on, we'll stay kind of sideways here, right? But if you ask me 6, 12, 18 months down the line, you'd want to be buying this hand over fist, even if you're storing barrels of oil in your backyard, right? What is it? Canada crude. You could buy a barrel for the price of a Starbucks coffee. That's a trade I'll take any day if I can store it or whatever. Looking at further down the line. But right here, it's very, very choppy. So I think especially if you're a retail trader with a small account, or even a medium-sized account trying to trade the futures here, that's a great way to get in trouble on the headlines. I think there are far more opportunities out there, right? Especially with the VIX trading where it is and the kind of moves we're seeing on equities. Nobody's really forced to go and trade anything else, right? That's what I would say on crude. I don't know if that answers your question or not. What are my thoughts on long-term behavioral change in the world impacting long-term consumption? I think that's not really relevant to the webinar or the charts, right? That's more for a chat over a pint. But again, that's not really relevant to the chart. See, the problem is, and I know this is a little bit controversial, I think a lot of less experienced traders, a lot of junior guys, they spend their time with these kind of like metaphysical discussions or mental masturbations about what impact this is going to have 2, 3, 5, 10 years down the line. And what happens, Adam, inevitably, whether you realize it or not, that will automatically put some kind of a bias in your head, whether you realize it or not. And usually as a trader, and especially if you're a young trader with less experience, that bias is likely going to kill you or stop you from taking advantage of what the chart is telling you. So I would recommend that you don't worry about those things, that you worry about the charts, right? Anything that can distract is not ideal. Okay, I'm going through the questions, guys. Again, no particular order. I'm just trying to tackle as many questions as we can. So here we are. What's going on with the yen pairs? Could you give me a little bit more what's going on? It's a really broad question. As a general rule, if you give me a more detailed question, it's going to be easier to answer than a really broad one, right? So Mayafra in the house, man, that's been ages. How's it going, man? What's going on with the yen pair? So yen here is a little bit, so I'm looking at dollar yen since I have no more, you didn't give me anything more. Here, what's happening on dollar yen? Well, absolutely nothing, right? We're kind of stalled. Similar kind of like what happened on the equities, right? You see, this is one of those situations, remember when shit hits the fan and people have to deleverage and the margin clerk is knocking, everything is the same trade, right? So if you look at whatever chart you want to, it's all the same trade, especially in the panic, it's all just a dollar trade, right? So here it's exactly the same that's been happening across the board. So here on the yen, what to look at for the yen? Well, it's stuck. It's stuck. There's not an awful lot going on. What you see here already, unless this trades above 112, nothing much to say. And unless it comes right back down, there's nothing much to say, right? We came into the year very aggressive. This is the trade we've been trading the most in the past 12 months, probably very aggressively short yen, looking for that 104, 60 to get taken out. And we were looking for the 100, right? Our base case again was saying that, all these kind of, there's always unfinished business in these kind of areas. There's no such thing as triple bottoms. There's no such thing as triple tops, right? And the whole situation and the context and the charts for us was a very clear signal. We wanted to be very aggressive in still holding short yen exposure. So again, that trade is done and dusted, right? And you see how all the moving averages are clustering up here. Now, it's similar to the ES trade in the sense that you've got a problem, right? BOJ is not going to be too concerned about the yen, really, unless we start to challenge this 100. And you can bet your bottom dollar they're going to be in the house doing something. So it's hard to, it's the same thing. You don't want to short crude in the teens. Or you don't want to get long crude at 150 or 120. You don't want to get short yen into the 100. If anything, you get long. So here, the shorts were done. There was a very nice little long, and now we're kind of stuck. Base case scenario here is that also, if you look at seasonals, the way we're going to be going into Golden Week in Japan and everything, that tends to be bearish. USD JPY, so stronger strength in the yen. And also, if you think of the way we've rallied up here in the equities, right, when you've seen these ramps, you would expect to see a little bit of a pullback, right? Now, also keep in mind that for example, on the ES here, right, we had, let's get on a daily, we closed. You see how the market was trying to defend the 50 back of the move from A to B, right, very aggressively here. Then a second day, and then we got the Fed not happy throwing the kitchen sink at it, right? Or whatever. It just came up with a whole truckload of bathtubs and chucked them at the market, right? On Friday. And what happened? Well, we couldn't even close above. We couldn't even close above that 50. So here, to me, this would suggest that we're coming in anywhere here. Maybe we get a little bit of a pop, but it's time to play for some kind of a little bit of a pullback on equities, right? I prefer to be positioned slightly tactically short here than long. I think the longs are scaling out tactically short. And that would also help the thesis of seeing how this yen is kind of slowly stalling here, right, in this whole area, this confluence of resistances, and also the confluence of all the moving averages. So if anything, I'd be looking for a little bit of a pullback in the yen. But again, I'm not looking for crazy moves right here, right now. We have to see if we get any kind of comments over the weekend, whatever's announced, etc., etc., etc. Okay. Yeah, well, Joe, remember, anything that's hard to imagine will sooner or later will happen, right? Just don't let anything surprise you. But what we always say is you don't want to look at, this is what I always say, anything is possible, right? Some people ask me, hey, is this possible? I go, sure, everything's possible. The question is it, how probable is it, right? And what's your risk reward to play on that probability, right? That's the key, right? It's not, everything is possible really, but it's how probable, first of all, and then based on how probable it is, based on in relation to the location prices at this moment in time, is understanding that probability and understanding what kind of risk reward or what kind of trade you can structure around that probability. That's the trickier thing, right? That's the harder thing. Okay. So, my opinion on the Canadian dollar. So, my opinion on the Canadian dollar, USD CAD. So, we came into CAD here. This was one of our key themes for 2020. Okay. This is one of our key trades. I mean, sooner or later, I'll have to, if I get around to it, I'll probably release the video we did for subscribers at the beginning of Jan. But one of our key themes for CAD was that this was going to, well, again, it's in line with our short on the equity, etc. But our base case here was that CAD was going to be one of the trades that was going to catch most people off guards. And we had a very asymmetric trade here around the 131. And our base case was that we were going to fly out of this wedge, triangle, whatever you want to call it, right? And try and catch everybody off guard and squeeze very aggressively towards those highs. Okay, so right now, what's happening in Canada? Again, it's the same chart across the board, right? You just have to some of them you have to flip them on their head, right? But here, our base case is that no matter what you throw at it, really, in terms of fundamental, Canada is a little bit of a Ponzi scheme, right? And the situation in the Canadian economy is horrible. Not only with the shutdown now, but not only with the shutdown in commodities, but in general because of the leverage and everything. So I'd be a lot more concerned about, banks going under in Canada than anywhere else, but they'll probably step in and save them. So here, we've had the easy move, right, or that big move done, and now we have to see what's happening, right? And what would be focusing on? It's again, similar to the gold in a certain extent, similar to the ES. Here, you'd be looking to see how we trade, right? Any kind of move back down into the 50 back of this move from A to B, right, which is also in line with this. The breakout here, you've got this nice little gap up here. Any move down that holds, again, assuming things are going to get worse before they get better, you'd expect that to reload for a move higher, right? Where would the 123 extension of that move be? That would be above 150, right? But here, in the same way that the interesting longs or gap up, break above here, long, stop below the gap down. Does that make sense? That's a very classic trade, right? We're holding here. You've got, let me make it bigger. You've got this consolidation here, right? All of a sudden, you've got the market gaps up above the trend line, and even the first close. You're long, stop below these lows, and you're looking for this to go out and take out those previous highs. Very nice trade, very, very aggressive, but it's very nice. So in the same way that we had some interesting longs here, both, and we talked about this on Twitter too, the longs around the hold above the 131 and this long on the break up, right? Add if you're aggressive, etc. Here, you can't get long into this area, right? If anything, so the easier longs were done, the easier shorts were done, and now we're kind of in a sideways chop. We have to see what happens. It's a little bit in no man's land. So would I be bullish? Sure. Would I expect this to go higher? Sure. But this is not, this is classically for me in an area where it's not cheap enough to buy and not expensive enough to sell. I'd need to see it lower to buy it, right? Hope that answers your question on dollar Canada. What's my view on the dollar? Well, again, the view, we've discussed this a lot. The view on the dollar is that a strong dollar breaks the world, right? So we're sellers of any rally in the dollar, right? And this was another layup. I discussed this on Twitter too, and we said, you know, first you're gonna get the monetary, then you're going to get fiscal, and the next things that Trump is going to have to tackle are going to be the dollar and crude. And you got, you know, and exactly, you start to see the Fed coming in with those dollar swaps, etc. Dollar got tackled, and then crude got tackled. You know, the stronger dollar is going to absolutely break everything. So that doesn't mean that short term we can't get some kind of liquidity squeezes and pop up in the dollar, but any rally, aggressive liquidity driven spike in the dollar for me is a sale, right? And that's our fundamental view on the dollar. Does it mean that it can't stay in this range for ages? Absolutely not. But any spike for us is a sale. As we've been discussing, only if you get sustained hold above that 100 that doesn't get smacked down straight away, or only if you get a sustained hold below the 96 that doesn't get bought, then things change a lot. If not, it's just a lot of wheeling and dealing as everything else has to get sorted out, okay? So what is my view on cable? Well, the chart is guiding on cable here, right? So what's going on cable here? And just for funsies, we can put, you see all the moving averages are coming in around that that 128, right? So nothing has changed for us on cable, and the chart is going to guide, okay? So above 123.70s, looking for 128s to come into play. Above 128s, looking for 132s, etc. Below 128s, back into the 132.70s. Below the 123.70s, back into those lows. Globally, in terms of fundamentals, I think the situation, the UK is lagging behind the other countries or European countries with COVID. So situation is going to get worse before it gets better. Bojo and company could have reacted a lot quicker. They decided not to. So that's not going to bode well longer term. And then we also have to deal with with Brexit, right? So there's a lot of stuff they have to deal with. So I would fundamentally, or bigger picture, I would not be surprised. I would be more partial to be a seller here, right? To be a seller or of failures at the key levels for a longer term before the year is over, a retest of these lows, right? But having said that, I'm not, I don't care long or short. I'll just be looking at the levels. Right here, right now, it's not expensive enough to sell. It's not cheap enough to buy for me, okay? Do you avoid trading 4-hour bars during DST time shifts in your... Oh, that's a good question. Somebody who's paying attention. So again, do yourself a favor. Don't try and front run the New York 4-hour closes by trading them on GMT. Very little edge doing that. So I assume what the question is from Mark is he's noticed that because of the time change, when we change to summertime and wintertime, you've got like 1 week, depending on the time, 1 week or 10 week or 2 week time, 3 week time when the charts are out of sync. So it just means that one country has shifted, but the others haven't. So the 4 hours closes don't occur at the same time in Europe as they usually do because of the time change, right, Mark? And so your question is, would I still trade the 4 hours the same way? I usually don't put as much weight as I would normally do during that period, okay? Because everything seems to be a little bit off. All the relationships tend to be a little bit off. People coming in and out of the offices, things are happening at different times. So I tend to put a little bit less weight on the 4 hour closes when you don't have the normal relationship. Let me know if that answers your question, if that was your question. Cable done. Done. USD CAD done. Hey Mango, how's it going? All the best. Zip F, has that answered your question on yen or no? Let me know if you have any other pairs. When you say you would be trading more aggressively, does that mean you would be more leveraged or something else? As far as we're concerned, to me, aggressiveness comes in how I manage my position or at order entry, not necessarily in terms of position size, okay? I have a feeling, and thank you for asking that question because it gives me a chance to clarify. I think the usual novice traders think that when somebody says aggressive, they mean strap up your armor, pop over, open that other can of Red Bull and lever until you get a tap from the risk manager on your back. That's absolutely not what I mean about being aggressive, right? To me, being aggressive means basically either playing a trade where I have a worse risk reward or where I have an inverse risk reward reverse sometimes, right? Because interesting risk rewards make sense, but not always. But those, to me, I consider those more aggressive trades. And so that's one way where I'm more aggressive. The other way I tend to be more aggressive is at order management. So so it's the way I will be wider stops and wider TPs. That's still in the line of the structure of the trade of risk rewards. And basically that's the way I would trade around it. My max leverage on any specific trade will not necessarily change. I will not be looking to lever up like a crazy man or a crazy woman. I'm just looking at it in the sense of I'm willing to give up trade location because I think the trade is extremely good or extremely interesting, or I'm willing to give up risk reward because I think the trade makes a lot of sense. But I'm not changing the size. Okay, I'm not changing the size. I hope that answers your question. Sorry I got thrown because I'm gonna have to kill somebody that tried to call during a webinar. They don't know, but they're lucky I can't leave the office. Do I agree that there is a rising wedge pattern in gold? Usually it's not a question of do you agree or not. Either a pattern is there or not. We reviewed gold earlier, but again, trade whatever patterns works for you. I have no problem any trade, right? On a 4 hour, let's look at it. Guys, I know we're going. Look, I'm going to try and get through as many questions as I can. I'm going to get killed if I go on for too long. We've been going on for an hour, but I'm happy to hang around for another half an hour if I have to. So bear with me. I'll get through all the questions. As long as there are questions, I'll try and get through them, okay? So 4 hour. Yeah, I don't know I'd have to see what you're drawing. What do I see on the 4 hour? I don't really look at things that way. I mean, if I had to draw something, I don't know what you're probably talking about. It's breaking out here. What I'd be a lot more focused on the 4 hour if I'm looking at this chart is just that clearly we're seeing a squeeze higher, but what you're seeing selling coming in, right? So it looks like selling is trying to come in it's unable to attract any real new selling at highs. So all those sellers keep on getting stopped out. And I think it's small retail continuing to try to hammer this on with small sells, and they keep on getting taken to the woodshed. Everybody looking to try to place some kind of inverse head and shoulder or shampoo bottles or triple tops, and they just keep on getting taken to the cleaners because the environment is not a bearish gold environment, it's a bullish gold environment. Here's a problem where you really have to understand, either you have to be disciplined with your stops, or you have to understand where we're trading, or you're going to get taken out, carried out if you're too stubborn on these trades. Hey, Debbie in the house, how's it going? So let me go through next question. Random question. Did I hear you say that you were located in Canada? No, I'm not located in Canada at all. But I do follow Canada quite closely. I was wondering if you had some reading recommendations on market sentiment and reading market psychology. It's, you know, there are a lot of things you can read. I think what is useful is to spend as much time trying to really understand the charts. You know, most people they say, oh, I've been trading for 5 years. And then when you ask them a basic question about a naked chart, they can't answer that. They don't recognize specific things. So I would be putting a lot of effort into really understand what's going on price on blank charts. Having said that, if you're thinking about the recommended reading on market sentiment or market psychology, a lot of people talk about, you know, it's always good. I think a beautiful read is always reminiscence of a stock operator, and people will always recommend that. One book which we reviewed when it first came out, and I saw a lot of people talking about it this year. I think it's probably 4 or 5 years old now. It's The Hour Between Wolf and Dog, or Dog and Wolf, something like that. That's a really great read. And then probably the classics. You know, I like reading books. I don't read as much as I used to, but I should. But books that are cool are books about people where you see their struggles. So, you know, the Market Wizard books, yeah, they're good, but I think sometimes they do a lot more harm than good. I know I'm going to get crucified for saying this, but I have a feeling that a lot of the Market Wizard books, people read them and then they all want to be a masters of the universe. And what you forget, that most people in that book have blown up since, or blew up a couple of times before getting there. And then everybody wants to be a hero like the Market Wizards. So I'm not they're good, especially the first one, but don't want to be a market wizard, right? Another good book, you know, Pitbull is a great book, right? A lot of people like all the Mark Douglas books on psychology of trading. Those are good. But The Money Game, Adam Smith, that's an awesome book. It reads like a novel, and it's about, you know, all these books, you can read through them and not get anything out of them, or if you read them properly, linking them back to the right things in the market, they could be of a lot of use to you, okay? All these books I mentioned are really interesting. The other thing, Tom, keep in mind, and this is a pet peeve I have, some people, the same book can mean something different to the same person at different stages of their life or their trading journey, right? There are certain books that you may read at 10-year intervals and they mean something completely different to you, right? Just because of the time and your experience. And there's some books that just will mean nothing to you at certain times, or you can't, you know, they've been books I picked up like 10 years ago and I couldn't read past the 5th page. It just put me to sleep. And then I pick them up recently and I'm like, wow, this is awesome. Why? Because the timing has to be right. The mood has to be right. The experience has to be right. But Reminiscence is a great one. Hour Between Dog and Wolf is a great one. Moneyball, Adam Smith, if you can get your hand on it, is a good one. Pitbull is a great book. Delusions of Crowd is an awesome book, is a good book. There are a lot of good books out there. Can you comment on Euro AUD? How low can it go? Very low. I don't know. Let's look at it. I don't look at it. I really don't look at it. I don't look at any of the exotics or any of the funny pairs. I never look at them unless somebody asks me. So I always prefer to express the trade through the major. So I don't look at it. So Euro AUD, how low can it go? Well, the chart is telling you that it can go all the way down here, right? So there's still a lot of room for it to go. Question is, how low will it go, or what are the chances of it going that? I mean, right here, you're going to get a little bit of a squeeze, right? Keep in mind that as long as the situation continues, there's far more chance that structurally Euro's going to get their shit together. And if commodities are dead, Australian dollar is not going to be too good. So this is pretty much a risk pair trading. But to me, it's kind of like dog against dog. I don't have a lot of interest in it. It's not something I would ever trade. Right here, just looking at it structurally, what I would look at is that, say here we're on a weekly, so we're looking at it from 2012. So what I would say is, well, it looks like it did an awful lot of nothing for a long time, but in a bullish kind of consolidation, it's finally broken out, right? You also have these previous highs here. So on any dip that holds this breakout, it's a long. And if it gets back inside this zone, you'll probably see a lot of choppy situations here, but it will take something very substantial to get the AUD, so the second part of this trade, strong and through this area. So how low can it go here? I would suspect before it finds buyers, it should find buyers around this breakout zone, right? This area will probably find some buyers. Let's go through some other ones. Further to your dollar view, what would be the best pair to take advantage of that view? Well, it's different, and I think you don't have to take that view on through the dollar specifically. You can take that view on through equities or through commodities too. I would always recommend, instead for a junior trader or a younger trader, instead of having a structural view or a position on a bigger theme, I would always recommend to trade each chart independently rather than trading a theme, because you'll need much wider stops. It just takes longer to play out. You can get whipsawed out of the trade. So I'm not a huge fan, but it's a tricky one right here because of the dollar component. So you could argue yen, but the yen will probably get into trouble further down. Longer term, a controversial opinion could be through Euro USD longs, but I would look at each chart individually rather than looking at a position trade. Do you look at the previous week range to qualify the probability of a fake out candles when you use them? No, I very rarely look at the previous week's range. I'll look at previous week action if it's in the context of a bigger thing, but on a daily perspective, if that's what you're asking, I will not be looking at the previous week range. Yes, that does answer my question. Good. Getting through all of them. How many hours do you trade a day? That's a good question. If you go fishing, do you calculate all the hours you're outside going fishing, or are you calculating the times you were at home making getting the bait ready or making the flies and scouting out the river, etc., right? So if you're only calculating the times where I'm hooking a fish and reeling it in, probably 1 hour a day or something like that. If you talk about getting the flies ready, scouting the territory, understanding the context, understanding the weather, and whatever, probably 24/7, but more realistically 16 hours a day or something like that. I hope that answers your question. Do I use VWAP at all, or no, I don't. There's nothing wrong if you want to look at it, but I don't use it. 4-hour bars, what are the place in the world to yeah, well, if you're looking at 4-hour bar, whatever you're doing, anything I do, I will always look at New York time. That's Champions League. I don't know where you're based, but that's Champions League or NBA or NFL, right? GMT closes, it's not what I look at. Most majority of the people are going to be looking, whether you're talking about moving average, whether you're talking about any indicator, whether you're talking about candle closes on New York time, okay? It doesn't matter where you are in the world, everybody's going to be looking at those. If most people, when people are talking about a 200 DMA, when people are talking about a 4-hour close or a daily close, they're going to be talking about New York time. I'm sure I'm not going to answer any specific trade related questions to a specific trade you're in, but this is the biggest mistake I find that retail traders do, or junior traders in, probably because of the fact that you can take the opposite side of your trade on MT4. They always like to hedge their positions. Remember, you should trade each chart individually. More often than not, if you try and hedge something that's going wrong, you're going to lose money on the original idea and you're going to lose money on the hedge. Remember that you have to take off the hedge at some time. If not, you're not making any money, because what you're making on one, you're losing on the other, assuming it's a perfect hedge, And if you couldn't hold it together, that you had to start hedging all kinds of positions, chances are you're going to get the timing wrong and you'll lose money on both sides of it. So just trade each chart individually. Okay. Oh man, watch out. Look after yourself. Hope you're doing good. What about AUD USD? Sure, Aussie. What's going on Aussie? Well, I mean, Aussie is not pretty. You had a nice long opportunity. This has been our major short of 2018, 2019, and you see how it was very, very technical in the way it traded to the short side. This is a weekly, but you can also look at it on a daily. But here, what you can see is all these tests were pretty much at the 200. It's hard to ask something as beautiful and as trending as this, where it was pretty much, beautiful. You see all these rejections at the 200, completely stayed in trend, was very, very beautiful, right? Except this one, which we did not trade because of the way that you had the bottoming pattern. So that was when it was over. This was the last short we took on Aussie, right? Now here, what we were looking for a break into the down into the 60 mark, and that was our pivotal level. That's kind of like that low, that weekly low you have on crude, right? And you can look at it on the monthly, and you can see that's exactly where that came in, right? So that's exactly what was going on. And in the sense of what we said, is we discussed this on Twitter too, I think, if anything, you'd get long on that failure to hold below the 60. It's the same trade across the board. It's like the short on USD CAD. It's like the long on equities, right? It's the same trade across the board. It's just a little bit of a relief rally on the de-risking of the little panic low. So here, as long as that 60 holds, there's a risk that this goes higher all the way back into the breakdown zone. But if anything, assuming the world is not going to open up again, assuming airlines are not going to fly, assuming commodity prices are going to be in the crapper as they would, all things being equal, this is getting close to another short for at least another retest of those lows. Even if you manage to get the financial engineering that tries to fix anything, you would have a hard time seeing this getting a lot of substantial upside traction. So if anything, I would be looking for shorts on this, okay? Let me get through the questions. CHF JPY. So I'm going to regret saying I'll get through all the questions. So CHF JPY, what do you want to look at? It's hard to say anything about this because it's going nowhere, right? it's going absolutely nowhere in a hurry, right? And it's not surprising. It's dog against dog. This is a classical dog against dog trade. It hasn't gone anywhere for years. So it's very hard to decide what to do here. The range is so tiny, both to the upside and the downside, that it's showing you that there are far better ways to use your capital, far better uses of your capital than to try and do anything right here, right now. You can express any kind of idea through any other chart. It's really not that interesting, right? Yeah, we'll get through. You have to ask a specific question, and I'm not going to go through anything that I've gone through already, because if not, we're never going to end. You can watch the recording. How many people are in the webinar here? No, there's no daily limit. I think there's a limit of, I'm not sure. No, I don't think there's a limit today. There's no problem, right? Oh, you mean the daily webinars we hold? No, there's no limit. They're still open. Do you think we will bounce from the 208 low? Are you talking about what chart? What chart are you talking about? Again, there are a lot of questions coming in one after the other. So if you don't tell me which one you're relating to, it's very hard. Okay, AUD. Here, in terms of where we are in relation to the 208 low, we've already bounced from it, right? That bounce is in play. So it's at the 60. So as we were watching that very closely, break below and failure to hold below is a long. So as I said, we're looking for this to try and come higher, but where any of these moving averages is starting to be an interesting point to get back short, not long. What are my stop loss rules? Well, that really depends on, there are a lot of different ways of doing it. I don't do it in terms of percentage trade. Or I don't always risk the same. I have a percentage loss limit, right? So I work in terms of percentage loss limit. So everything to me is a question of how probable is the trade I'm looking for. What is the probability of it playing out versus what is the risk reward I can get? And I have a risk budget every day. I don't want to lose more than X amount every day, every week, every month. So if I'm over my risk limit for the day, week, month, I'll stop trading. But it's not done as I don't always risk the same percentage of my my account. Hey, my offer, my pleasure. So Ray, do you experience drawdowns as a trader? Anybody who tells you they don't have any drawdown is lying, and you have to run as fast as you can. Remember, anybody who knows anything about trading will know that the largest drawdown is always ahead of you. Anybody who does not understand the fact that the largest drawdown is ahead of you you shouldn't be listening to. Of course, everybody has drawdowns. Everybody has big drawdowns. It's all a function of how much risk are you willing to take relative to the reward you're trying to get. But everybody has, there's still space, Mark, in the premium ones, sure. Everybody has. Do I use BB Bollinger Bands? I don't really use them, but I have no problem using them. If you're looking for a measure of volatility or give you an idea for range, I think Bollinger Bands can be useful. I think a lot of people get in trouble because they think they're absolutes, or they have to stop in the same way they get in trouble with RSIs. But I have nothing against Bollinger Bands. Yeah, Tio, I mean, all the commodities are going to get whacked, right? Think about the supply chains. You're in a situation where all these farmers a lot of them can't even harvest the stuff they need to harvest because they don't have any people to harvest it. So they're just letting it rot. Or even if they've harvested, they're having to throw it away. It's just a horrible situation. So short term, it's going to be a disaster, and it doesn't look like it's going to get better for commodities anytime soon. So it's not surprised. But any commodity that anybody is getting excited about talking about the fact that it's going to go to zero is starting to become an interesting buy, right? But of course, with a long-term horizon and on a cash play, so 1-to-1, no leverage. I have no problem trying to get in on any commodity that is trading, sitting on its butt. If it's a cash trade, if it's zero leverage, and you're looking to hold it for a long time, if you find a way to carry that position. But if you're trading it with leverage, it's a great way to get in trouble. Remember that the percentages change very quickly, right? Once something's at 10, it could be down 50% in a second. You see what I mean? So it's you have to be very, very, very small in size, right? What technical signal do I find the most interesting when initiating a trade? I think the most interesting technical signals to me is failures at horizontal support or resistances, right? I think those are the most interesting. Is the most interesting. I'm trying, Mark. Do you use Elliott Wave? No, I don't use Elliott Wave. I never use Elliott Wave. I have looked at Elliott Wave. I have studied it, but I'm not a fan. I don't look at Elliott Wave. Keep in mind that if you look at a lot of different things, you will have components, and Elliott Wave has components of different things in it. But I'm not a fan of Elliott Wave. Yeah, this is being recorded. It'll be recording. What do I refer when I mean failure? When I mean failure at a level, I mean on whatever time frame I'm using on the chart, I'm looking on the chart, is a failure to break above and close above, or a failure to close below and close below. When don't you look at the market and just don't care? I don't understand the question. Do you take yearly or bi-weekly breaks from the? I usually don't. I don't trade if the market's not really trading, right? So when there's nobody around, there's no liquidity, there's no edge. So you won't catch me trading between Christmas and New Year's, right? That's dead. You won't catch me trading on days where it's kind of like a bank holiday in one country but not in the other, right? You won't catch me trading on days where the futures are open half day or something like that, and you usually won't catch me trading in the middle August, the midweek in August, around the 15th of August, because volumes are very, 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 very shallow, very thin. There's very little edge. I mean, it can change that week if something is happening and if volumes are there and some crisis is going on, but usually I will let the market dictate, right? So for me to be prime trading conditions, everything has to be open. Futures have to be open. Bonds have to be open. FX has to be open. No public holidays anywhere. When you have those in-between days, I won't trade those days. There's no edge. It's much better to get refreshed, rested, and spend some time with friends and family. Waiting for confirmation for trades depends on the trade setups. You might trade setups. Depends what you're trading. Some people like to wait for confirmation. Some people don't. It really depends on the setup. Do I use... No, I don't trade CFDs, really. No. I'm not... No. I am always... I prefer... some people can't because some of the contract size are too big, right? But I'd always... trade futures, and I'm not a fan of CFDs. Not a real market as far as I'm concerned, so no. Is there a book on price action, naked price action? Not that I know of. Not that I know. Is it best just to trade? Well, I think it's if you have to choose between only trading one instrument or only trading one strategy, it makes a lot more sense for me to my preference would be one strategy over a number of instruments rather than one only strategy over a number of instruments, because things can change and you don't want to be technically unemployed basically with nothing happening, right? So keep in mind all the charts are the same. You might have different ranges or different vol or different character, but usually if you can understand a basic strategy, support, resistance, whatever, you should be able to trade that across any chart. So it doesn't really it doesn't make sense to me to limit yourself to one signal. Okay. FANG, what's going on in FANG? Well, FANG here, we're kind of stuck in a fairly familiar territory on FANG. And here, if you look at it on the weekly, it's the easiest way to look at it on the weekly chart, right? This is something I was posting a lot on Twitter. I haven't posted a lot of these charts for a while because nothing much has changed and it's all the same chart. So here, what's happening in tech, again, it's holding. I mean, all things being equal, if you think about it, the companies that have the highest cash balance or should have easiest staying power or still have a business going forward are the tech names. What you're seeing is a lot of wheeling and dealing recently here, also because people shifted out of tech and went back into the bailout nation to get the pop on all the bailout names. But I suspect, tech was the strongest all the way up and is likely going to be the strongest on the way down too, right? So I just, again, think you better look at each chart independently. It makes a lot more sense, but clearly I don't see any reason to be disproportionately negative of any of the tech names here, because they've got the strongest balance sheets, a lot of them, and they've got businesses that are still in demand and are going to work out quite nicely. So no real reason there, right? Yeah, I don't really have a preference. Day trading, weekly, swing, whatever works for you. Everything. There's no, I don't look at it that way. I don't look at it in terms of time frame, in terms of am I a day trader. I'm a trader, right? I'll trade anything that moves, anything where the risk reward makes sense to me. Okay. So what's going on in euro, right? So euro, a surprise, took, 1 hour and 28 minutes before people started looking at euro. So euro, what's going on at euro? Not an awful lot. We're stuck at the 108 mark, right? As I've been saying on Twitter, I thought the risk was for squeezes to the upside, not the downside. And you see we had some nice moves off this 108 and the market still bid. So base case assumption here is that euro will still find bids here below the 108, bearish, and expect the market to test these lows very, very quickly. The first close we get with any traction below the 108. Above, I think the risk is for it to take euro crowd out and squeeze to the upside. I think they're going to agree something in Europe, something's going to be solved, and you'll have some upside pressure on euro. Again, I think especially coming from the Anglo-Saxon crowd, people that are not in Europe, who haven't lived in Europe or don't understand Europe, are notoriously bad at forecasting what's going to happen in Europe and always think the euro is going to crumble, everything's going to go to hell in a handbasket, and they think, but they just don't really understand what's going on in Europe. So from a fundamental picture, I think they'll kick it down to the last second, but they'll find an agreement. You'll see some white smoke. Everything will be good. They'll sort it out one way or the other, and ultimately we'll squeeze a little bit higher. I don't think the euro is going to break down, at least not now, and I don't think everything's going to go to dust, right? And I don't think we're going to go back to each country with each individual currency, et cetera, et cetera. Technically, as long as it can't close below the 108 with any gusto, I still think the risk is to the upside to try and take out shorts on this spike, and a lot of choppy trade here. It's been very choppy for a while, and there's no reason why it should really break out of this range anytime soon. But for now, that's the way I'd be looking at euro, okay? What was the most detrimental to my career? For example, name reading things that end up default. What was the most detrimental to my career? Most detrimental to my career, I think the only thing I could say, the thing that's held me back the most as a trader, and the thing I wish I would have understood properly earlier was sizing, just risk, just leverage, size. That's the most important thing. You know, if you trade small, if you trade, keep your leverage down, and you build the leverage once you understand what you're doing and when things are going better, it's very hard to get in trouble. It's pretty much impossible to blow your account or get in trouble if you're trading one-to-one leverage. You'd have to try hard, and just random chance would dictate that you could not blow the account if you're trading one-to-one, pretty much. So the problems, all the problems, I think, always come from trading too big. So I think that's the most interesting thing, is understanding leverage. Will you start looking at individual? Yeah, I've started to look at individual stocks. I have names up. I have a list up, but you know, it's a much different game. It's a much harder game on individual stocks. So I mean, we can talk about them, Mr. Deadlift. We can talk about those in the webinars if you ever have anything you want to review. Anyways, you know you're in there, but nothing major now. Back to ES, I have a question about your thought process. So initially it put on, so let me get on ES on the daily. Yes. So thought process on the ES. And I think this is the last question because some people are having to run and we're gone over 1 hour 30. So this is the last question here. So I have a question about the thought process on the ES. So initially it put in a daily reversal candle from the 50 back area, but the next day it cleared the highs and lows, which would invalidate the idea. I don't agree, but I'll get back to it in a second. It then closed below the 50 back to end the week. As you said, this shows some weakness, but would you wait for it lower time frame to get entry? Okay, so I understand what you're saying. So first of all, remember, there's nothing magical about fibs. They're just support or resistance levels, right? So the fact that, and again, this is the way I look at the market. You guys remember Tiger Woods wrote a book probably 15, 20 years ago, and the title of his book was not How to Play Golf. It was How I Play Golf, right? And that's the same thing. I can only tell you how I use the fibs and what I do. So for me, your comment is market closed this candle, I assume, closed ahead of the 50 back, and then it traded back above it, so it invalidated the idea. So as far as I'm concerned, your idea was A to B, short it at a failure at the 50 back, and you're looking for it to continue lower. So your assessment is that because it closed ahead of the 50 back, but then it traded back above, it's invalidated that idea, okay? So that may be right or may be wrong, we don't know, but I don't think about it that way, okay? So I can't agree with that comment. So for me, the fact that what the market is telling me is that it tried to front run the 50 back in a normal area because we had this zone up on the chart. So it's reversing exactly where we would have expected it to reverse. So we're expecting that to cap it. We're expecting the sells to come in there, not at the 50 back. So the fact that the market tried to close it below the 50 back on the first test and move back above just means that the move down has less chance to me of playing out in an orderly manner or in a textbook manner. It doesn't invalidate the idea, okay? First of all. Second of all, would anything that happened mean that I have to change time frame? No, I never change time frame. I don't need to change. I don't change time frame, right? So to me here, there's two ways of reading this, right? So and this is, we'll go back to your bias, Adam, right? So here, what the shorts will say, look, we capped it. We tried to hold so day one. Day two, it's still closed below the 50 back. Day three, the Fed threw the kitchen sink and a truck full of bathtubs at it, and it still couldn't close above the 50. So what does that mean? That means die. We have to go to zero. It's finished. We're going back to 666. Okay? What are the bulls going to say? The bulls are going to say, hey, look at that. The bears, they tried to smack it down ahead of the 50 back. The suckers, they couldn't, because the next day we closed above, and the next day we closed even higher. And the Fed's got our back now, so buy them up, buy them up. The lows is in, we're going to all-time highs, right? So you see how the bias is going to dictate what's going on, right? Here, to me, technically, the only things you can assess is that the fact that the market tried to front run the 50 back means that the move down, if we get a move down, is going to be less orderly. Number two, it means that despite the fact that the Fed threw everything at it, it still didn't close above the 50 back. So the bulls kind of wasted a chance. And that because indeed this failed, there's a chance that it's going to try and go for the 61.8. But at 61.8, I have a bunch of moving averages there, and I've got the 3,000 psychological resistance. So to me here, what this is telling me is that the case for the quick move down so far is less important, right? Unless we get a massive daily close to start. To me, what this is indicating now is that as long as it can't close below the 2730, chances are we'll see a lot of chop inside 2730 and the 3000. Day close above the 3000, I would expect the market to try and rip everybody's face off and go back to new highs. Below the 2730, I would expect the market to try and rip everybody's face off and try and take a stab at those lows again. But for here, as long as it's here, it's a little bit of non-conclusive at the moment, okay? Okay. So guys, we pretty much tackled everything under the sun. 1 hour and 37, 1 hour and 38 minutes. Thank you everybody for spending some time with me. It was fun. Thanks for taking time out of your day. Hope it was useful. I tried to do as much I can. Hope I'm not gonna have to go. I'm gonna get in trouble on a holiday day doing a webinar. But again, let's see what we get, guys. Thank you so much for showing up. I wish everybody a safe day wherever you are, whatever you may be doing, a safe and peaceful quarantine, and spare a thought for all the heroes and true fighters out there which are working at all the medical facilities and don't have time to look at charts, don't have time to have a bias, and are just trying to keep anybody who shows up safe. Okay, so shout out to all the heroes and stay safe, everybody. All the best. Talk to you guys soon. Bye-bye. Take care.